Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be looking at Tyson Foods. We're going to be looking at it from the perspective of, okay, this is how we should be looking at companies. So when we find a company that seems for whatever reason interesting to us, for whatever reason, it could be, let's say maybe you like the food that Tyson Foods produces or whatever, you should have a strategy and a filtration process to go through with the company to see if this company seems like it's going to be, a good investment opportunity for you, basically. So I'm going to walk you through my own personal process, and hopefully this provides you with some clarity on what you should be looking at when you're analyzing a company for the possibility of it being an investment opportunity. So the first thing that generally I like to do is usually on the first look through for a company, I usually find it on Yahoo Finance. So I look, usually through Yahoo Finance for a couple of different things, and right away once I go to the company's page on Yahoo Finance here, usually the first thing I do is I scroll down and I read what the company does. So you got to remember, when you're buying stocks, when you're investing in companies, you're buying a company, and you got to understand basically what the company does. And the simplest way to do it is, you look at the sector, you look at the industry, farm products, and you read here on what it does. So we can read quickly together. It operates beef, pork, chicken, prepared foods, live fed cattle, market hogs, subprimal meat cuts and primal meat cuts, beef and pork, blah, blah, blah. So basically it produces food like mostly meat and things along those lines. And what I also like to do is I like to read the Wikipedia page about the company to get a better sense of what it actually does. So you can read through, for example, the company's Wikipedia page and so forth, and that'll give you a better sense of what the company actually does, on a day-to-day basis, where it makes its money from, and so forth. And if the company doesn't do things that are too complicated, that's a good sign. So it makes food. Well, people are always going to eat. It's never going to go obsolete. So you always want to be looking at that. Like, what is it that the company does? Is it understandable? Is it within your circle of competence, or is it something that you can basically understand? And Tyson Foods seems to be within that circle. It's not quantum physics. So once we get an understanding of what the company does, what I like to then look at is this chart here, which just gives me a brief overview of the revenue and earnings over the past 4 years. This is just a little snapshot. What I like to see is that the company is bringing in more money through its revenue and making more money through its earnings every single year. In terms of the earnings targets, I really don't care too much about that. Personally, I think it's stupid. The estimate is $1.98 that it's going to make that quarter. It makes $1.94, and it's stupid. There's no way to properly estimate that, so I think that's pretty much nonsense anyways. And that gives us an advantage over analysts who are looking at the quarterly earnings figures and basing their investment decisions off of that, because they actually don't know what they're doing. So I look at this, I look at the revenue, I look at the earnings, make sure it's going up. That's what I like to see. It's making more money every year from its revenues, and it's making more money through its earnings. Once that's done, usually I head over to statistics, and I look at what the market cap of the company is. What the market cap is, so when you buy a company, you buy the shares of the company. The market cap is the shares times the share price. So the number of shares times the share price. So it's $60 a share, right? And times the number of shares would give us $23.3 billion. So if you were to buy all the shares in the company, you would pay $23.3 billion for it. Then here we have the enterprise value. What the enterprise value is on top of the market cap. When you buy the company, you also take on the debt for the company, right? So if you own the entire company, now you also owe the debt that the company owes. So that is basically this market cap plus the debt, but then also minus the cash that the company has. So it's plus the debt minus the cash is what the enterprise value is. So really this is what you're actually paying the company for. So if you think about it, if you buy a pizza shop, right, and the pizza shop, you pay $5 million for it, but the pizza shop has $2 million worth of debt, then it's really like you're paying $7 million for it if you think about it. But then if the pizza shop has $500,000 of cash in the bank, then you would basically be getting that $500,000 worth of cash. So you'd actually be paying $6.5 million for that company. Even though you're paying $5 million, you're taking on the debt and you're also getting the cash for free, basically. Once that's done, I like to look basically at some of these ratios here, like the PE ratios, have some importance. price to sales tends to be more stable, so I do look at the price to sales ratio, which is basically the price was this market cap divided by the revenues. So the market cap divided by the revenues. It basically means that this 23 billion is less than half of the total number of sales that the company makes, and we can see here, it made about 53.28 billion, which is, comparing it to this market cap figure is basically what this price to sales ratio is. I like to look at the profit margin. I like to look at all these numbers, but we got to put these numbers into context, and we got to see what's good for the industry in question. What's really important here on this page more than anything else is this balance sheet information. So what we look at here is the balance sheet, which is showing what basically the company owes and what it owns. We can see the cash position, the debt, the current ratio, which is the current assets to the current liabilities, and so on. And this will give us a sense of how much the company owes, basically. We can look at the debt position here. We can see that this company has quite a bit of debt. It has $8.4 billion basically worth of debt. And in terms of net income, it makes about $2.43 billion based on the last 12 months. So once we get a sense of some of these figures, we can go into a little bit more depth in terms of the study. For that, personally, I use Y charts. And on Y charts here, I look through all these different numbers. It gives me a good sense of a general overview of the company. But then I like to go to data, and I like to look at, for example, the first thing I look at is what's the company bringing in, basically. So I look at the revenue, and I like to see this. I like to see the revenues going up. So we see that that's the case here. So we see over the past 12 months, it's brought in $53.6 billion worth of revenue. We can see that the trend is generally speaking going up, and that's a good sign. That is what we want to see. The next thing that I like to look at is the free cash flow, which is basically the money at the end of the year that the company is able to distribute to the shareholders if it chooses to. And we can see that over the trailing 12 months it's had negative free cash flows, but on average over the past 5 years it's generated $1.85 billion worth of free cash flows per year, basically. And so that's a good sign. And we can look at the annual numbers, and we can see that again, it's made about $1.83 billion on average over the past 5 years. Using these numbers, we can then also get a sense of how much what type of return we're getting as investors off the top by buying this sort of company. If we use the average free cash flow number, let's say 1.83, and we divide it by the enterprise value, which we said was 30 billion, which is basically what we're paying for the company, divided by 30.6 billion. So let's do that together. That means we're getting a yield on our enterprise value, a free cash flow yield on enterprise value of about 6%, right? So 5.9 or about 6%. So meaning when we buy this company is, whatever we're paying for it, it's yielding to us about 6% per year in terms of its free cash flows, which is fairly expensive. But we also have to look at the cash flow generating power of the business and what rate it's going to grow at. And to do that, what we can look at is we can look at the revenue growth over the past 10 years. And what this does is it averages out the last 5 years for the last 10 years. So this is what the revenue is grown at from 2012 to 2022, 2011 to 2021, and so on. And then this is just the average of those numbers over the last 5 years. And we can say that the company's grown on average about 4.4% per year, 4%, let's say. So meaning what we can expect is our free cash flow yield, which is 6% currently, to grow at 4% per year. In my opinion, even though this company is rated as being cheaply priced or attractive in terms of its value, it still seems to be, in my opinion, to be overpriced. And the reason for that is because there's not a lot of growth. You're getting a 6% free cash flow yield on average based on the past 5 years worth of free cash flows, with simply not a lot of room simply not a lot of room for growth. So, generally speaking, we are looking for companies that are able to grow quicker than 4% per year. When the company is growing at 4% per year, that pretty much means that it's capped out in terms of its growth, and it's just growing at the speed of the general economy. And we're generally looking for companies that are growing faster than that, unless they're available quite cheaply to us. We can also look at the return on invested capital that the company is able to generate, which is basically based on the money that's in the company, what sort of returns it's been able to generate to us. And we can see on average that's been about 10% per year, which is considered mediocre. So, as you can see, Tyson Foods reached, about maybe 15 minutes into my screening process before I determined that it was not the best investment. So that's sort of the process that I really go through. And I reached the point where I decided, well, based on the free cash flow yield on the enterprise value, this company seems to be a little bit overpriced. And based on the revenue trajectory, there doesn't seem to be a lot of room for growth. And based on the company's ability to deliver returns on the capital that's invested in the business, it also seems to be slightly overpriced. This is despite the fact that analysts saying that it's fairly priced. So, a good investor, oftentimes their opinions will be different than the consensus among the analysts, because the analysts are looking at certain numbers, but a good investor is probably looking at other numbers that are more important, like the free cash flow yield and the company's ability to grow its revenues and so forth, and the company's return on invested capital, like we're doing. So, by looking at those numbers, we're looking at, let's categorize Tyson Foods in this sense. Tyson Foods is a food company. It's this nice, simple business that is growing very slowly, that has quite a bit of debt, okay, relative to its free cash flows, and is delivering a mediocre return to us as investors, assuming that there's no growth in the free cash flows. So keep those things in mind. I hope this video was informative. Please like and subscribe, and if you have any questions, please feel free to ask in the comments section down below. Thanks.